How to evaluate stocks. Whether you're a beginner trying to pick your first stock or an experienced investor looking to sharpen your skills, this video will guide you through the key metrics and strategies to help you make smarter investing decisions. Stick around to the end because we'll also cover some pro tips from legendary investors. Before we dive into the specifics, let's talk about a key figure in the world of investing, Benjamin Graham. Known as the father of value investing, Graham believed that every stock has an intrinsic value, its true worth based on the fundamentals of the business. He argued that in the short term, the market is like a voting machine, driven by sentiment and speculation, but in the long run, it's a weighing machine, reflecting a company's true value. Graham's theory of intrinsic value is all about finding stocks that are undervalued by the market, where the stock price is trading below the company's real worth. This is the heart of value investing, buying low and waiting for the market to recognize the company's true potential. And today, I'm going to show you how to use some of the same techniques to find a stock's intrinsic value. Now, let's dive into some of the most important financial metrics you can use to evaluate a stock. There are a lot of them, but don't worry. We're going to break them down in simple terms. The price-to-earnings, PE ratio, is one of the most famous metrics used by investors. It tells you how much investors are willing to pay for each dollar of the company's earnings. A high PE ratio can suggest that investors expect strong future growth, while a lower one might indicate that the stock is undervalued or the company is facing challenges. But here's the thing. When you use the PE ratio to compare companies, it's important to remember that different industries can have different normal PE ratios. For example, tech companies often have higher PE ratios because investors expect faster growth, while utility companies might have lower PEs due to their steady, predictable earnings. So when using PE ratios to compare companies in general, you need to consider the nature of the industry and the company's growth potential. A company with a higher PE might still be a good investment if it's growing rapidly and expected to continue that growth, while a company with a lower PE could be undervalued or might simply be in a slow growth industry. The key is not to just look at the PE in isolation, but to think about what it's telling you about the company's future prospects. The PEG ratio improves on the PE by factoring in a company's earnings growth rate. This metric is famously used by Peter Lynch, who managed the Magellan Fund and was known for focusing on growth companies. Lynch liked the PEG ratio because it helps determine if a high PE is justified by future growth. A PEG ratio below 1 could indicate that the stock is undervalued relative to its growth potential. For those looking for consistent income, dividend yield is a great indicator. It measures how much a company pays in dividends compared to its stock price. John Bogle, the founder of Vanguard and a big advocate for long-term investing, believed in using dividends as a key part of building wealth over time. High dividend yields are attractive, especially for investors seeking steady income, but be cautious. A high yield could also signal trouble if the company is struggling to maintain those payments. Now, let's talk about the debt-to-equity, DE ratio, a key metric for evaluating a company's financial health and risk. The DE ratio shows how much debt a company has compared to its equity. A lower DE ratio means the company is relying less on debt to finance its operations, which can be a good sign of financial stability. Companies with lower debt loads have a lower risk of financial distress, especially during tough economic times. Essentially, a lower debt-to-equity ratio reduces the risk of the company going bankrupt, which means less chance that the stock will go to zero. Now that we've covered debt, let's turn to evaluating a company's growth and profitability, two factors that help you understand whether a company is positioned for long-term success. The first thing to check is whether the company's revenue and earnings are growing. Consistent growth is a sign that the company is expanding and gaining market share, which can drive stock prices higher over time. This is something Peter Lynch was known for, as he always focused on companies with strong revenue and earnings growth. Another crucial measure of a company's financial health is the return on equity, ROE. This ratio shows how well a company is using its shareholders' money to generate profits. A high ROE means the company is generating solid returns from its equity, which is a sign of a well-managed, profitable business. Famous investors like Warren Buffett love looking at ROE when evaluating stocks. He's said that he prefers companies with high and consistent ROE over long periods. That's because high ROE often indicates that the company is good at reinvesting profits into growth, while still delivering value to its shareholders. Now, let's wrap up with some pro tips from famous investors. These strategies have helped some of the world's top investors achieve incredible success. Tip 1. Warren Buffett. Look for a moat. Warren Buffett, one of the greatest investors of all time, looks for companies with a moat, a competitive advantage that protects them from competitors. This could be a strong brand, proprietary technology, or a dominant market position. Companies with a moat can fend off competition and maintain long-term profitability. Tip 2. Peter Lynch. Invest in what you know. Peter Lynch is famous for saying, "Invest in what you know." He suggests looking at companies whose products and services you understand well. If you can grasp how the business works and believe in its future, you're more likely to make better decisions as an investor. Tip 3. Benjamin Graham. Margin of safety. And finally, Benjamin Graham, the father of value investing, always emphasized the importance of having a margin of safety. This means buying a stock when its price is significantly below its intrinsic value, giving you a cushion in case things don't go as planned. This margin helps reduce risk and increases your potential for profit when the market eventually recognizes the stock's real worth. It's a strategy that's been followed by successful investors like Warren Buffett for decades. So there you have it, a beginner's guide to evaluating stocks. We covered the key metrics like PE ratio, PEG ratio, dividend yield, debt to equity ratio, and how to look at growth and profitability. These metrics give you a solid foundation to start evaluating companies and making informed investment decisions. If you enjoyed this video, don't forget to give it a thumbs up, subscribe for more investing tips, and hit that notification bell so you never miss a video. And let me know in the comments which stock metrics you use or which stocks you're interested in right now.